What if I told you there's a predictable market pattern that repeats every single year, driven by a massive flood of cash? It's not a secret hedge fund strategy. It's something you can see coming from a mile away. We call it the Refund Rally. This is how smart money anticipates market moves, and today, I'm going to show you how you can too. The entire strategy is built on a simple idea: tax season. Every year, trillions of dollars shift around the economy, creating a predictable five-wave sequence of capital flow. Smart investors don't wait for the news. They front-run these waves. Let's break it down. Wave 1 is the front run. This is happening right now. Before a single refund check is mailed, speculative money rushes into high-growth areas like small cap stocks and consumer discretionary. They're buying in anticipation of the coming cash injection. Then comes Wave 2, the consumer flood. This is when the real money hits. The average household gets their tax refund, often thousands of dollars, and that cash flows directly into retail, restaurants, and leisure. This wave validates the early bets made during Wave 1, sending those sectors even higher. Next is Wave 3, corporate repatriation. It's not just individuals getting a cash boost. Favorable tax rules encourage big corporations to bring billions of dollars back home from overseas. This adds a huge layer of structural support to the stock market, often benefiting big tech and other large-cap companies. This leads us to Wave 4, the capex boom. With all this cash on their balance sheets, and incentivized by things like bonus depreciation, businesses start spending. They upgrade their technology, buy new machinery, and invest in infrastructure. This is where industrial and technology sectors really start to shine, broadening the rally beyond just consumer goods. But this sugar rush of liquidity has a side effect: inflation. And that brings us to the most important part of the strategy, Wave 5, the late-year pivot. As the initial stimulus fades, the market wakes up to the fact that all this new money has devalued our cash. The smart move here isn't to hold on to your high-flying growth stocks, it's to pivot to defense. So, how do we actually trade this? It's about being in the right sectors at the right time. We divide them into two phases, attack and defense. In the attack phase, which covers the first 3 to 4 waves, we focus on capturing the initial liquidity surge. Your first key sector is consumer discretionary. Think retail, autos, and travel. They are the most direct beneficiaries of Wave 2 when consumers start spending their refunds. Second is small cap equities. Historically, these stocks are the first to move when new money enters the market. They're more volatile, but they offer huge upside potential during these early year rallies. The third and fourth attack sectors are technology and industrials. As corporations repatriate cash and start their spending spree in Waves 3 and 4, they're buying everything from software and servers to fleet vehicles and heavy machinery. These sectors tend to rally a bit later than consumer stocks, but the move can be powerful. Now for the critical defense phase, which corresponds to Wave 5. As the rally matures and inflation concerns grow, you need to protect your profits. The fifth winning sector is energy. As the economy heats up, so does demand for oil and gas, making energy stocks a classic inflation hedge. And finally, the sixth sector is basic materials. We are talking metals and mining. In an inflationary environment where cash is losing value, hard assets like copper, steel, and even gold become the ultimate store of value. This is where you park your capital before the party ends. Let's put this into a concrete timeline. Since today is January 21st, 2026, we are squarely in Wave 1. The smart money is already buying. This means the time to act is now. But this strategy comes with a strict warning. You can't hold on forever. We operate on a 6-month lockup. If you start building your positions in January, your target exit window begins in July. The goal is to ride the waves of liquidity up and then get out before the momentum fades and the market turns. This isn't a buy and hold forever plan. It's a strategic, timed operation to capture a predictable annual event. By understanding these 5 waves and rotating through the 6 winning sectors, you can stop reacting to the market and start anticipating it. Thanks for watching. If you found this breakdown helpful, make sure to like, subscribe, and hit that notification bell so you don't miss our next strategy deep dive.